Hey everyone, good afternoon. Eddie Wilson with the American Association of Private Lenders and Think Realty. We'll just let everyone kind of populate on here for a minute or two. So just hang tight for about 60 seconds to a minute and 20 or so, and we'll jump right in. All right, good afternoon. Thank you so much for joining us. For those that you that have jumped on, I appreciate it. We've got quite a lot to go over today. Again, thank you so much to all of the people that are joining from the American Association of Private Lenders, as well as Think Realty. A lot of the Jurassic folks joining us, as well as CMA. Thank you so much for pushing this out. We've got a very important matter that we want to discuss to you, and we've brought some experts to the forefront today to speak to you about this issue. As you know, both the American Association of Private Lenders and Think Realty platform, they have GRCs. We have government relations committees that both have watchdog groups watching for our interests, both on the real estate investment side as well as the private lending side around the nation and specific to each region. And one of these issues has just recently came to light. And so I'm going to turn it over to the Chief Counsel of the American Association of Private Lenders, Nima, who is one of the partners at Jurassic, to kick us off and kind of explain to us what's going on in the California legislative world.
Appreciate that, Eddie. And thank you as well to everybody that's on here. A few housekeeping matters. It's a Zoom meeting, so obviously there's the chat box and Q&A box. We'll reserve some time at the end for Q&A. Please rely on the Q&A box rather than the chat box throughout this to answer presumably some of your questions on the front end. Yes, this is being recorded. Yes, this will be distributed after the fact. So if you do need to drop off for whatever reason, this will be available later for you to watch as well. So going through here, first, how did this come about? We were notified of a tip in which a piece of legislation, specifically AB 1771 here in California, is being proposed. After a quick review of the legislation, it became very obvious that this had a huge impact. For those of you who track national legislation, you may or may not be familiar with New York. They tried to do this exact same thing a couple of years ago. They also called it a speculative tax and called it their Speculation Act. So it does show you the copycat effect that occurs when one brilliant state comes up with an idea and another just tries to come up and copy it and claim that their idea is even better. So a little bit of that occurring here. So what is this act? The first thing is that it is a California capital gains tax that is assessed on all residential properties. And we'll get into the exceptions in a second here, but know that it is a capital gains tax assessed on all properties, which is assessed at the time of sale or exchange for any form of residential collateral. And it is a 25% tax if the sale occurs within 3 years of the purchase. So that's the time period. And we'll talk about the sliding scale as well, but it's up to a 25% California tax, in addition to any other tax that may be available, any federal tax. This is just an additional tax. And the funds that are created inside from these proceeds would go into what they are calling a speculation recapture community reinvestment fund. We'll talk about all that in a second here as well. So why are they doing this? What was the rationale? When you read the legislation, obviously it's no surprise to anyone, housing prices have been dramatically increasing in California and really nationwide. In the third quarter of 2021, the California Association of Realtors identified that 51% of all purchases in California were purchased by investors, and the national average was 19%. So The California state legislature is looking at this and saying, well, that's problematic. We have people who are trying to buy their first homes who are not able to buy their first homes because these investors are swooping up and taking that opportunity away from them. So how can we try to slow down the effect of investors coming into California to even the playing field? And then they also posit, without stating any really evidence, which is saying that, well, investors also not only are purchasing it, but they're also purchasing it at higher prices than a first-time home buyer would purchase, again, without any evidence of that's actually true, but that's one of the arguments that was made in the preamble of the legislation. So we talked earlier about the sliding scale. In the first 3 years, it is an additional 25%, and then it goes down 5%, as you can see here, each and every year thereafter until it completely tapers off at the end of 7 years. Note that this is on the net capital gains. So, for example, in a fix and flip project, all the capital expenditures such as rehabilitation, carry expenses, those sorts of things would come off of this, would come off of the net capital gain. And depending on when the property was sold or exchanged, you would be assessed an additional tax on these amounts. It's both a corporate tax as well as an individual tax. So regardless of how you are formed or own the collateral, this is the tax that would be assessed at that time. So what collateral is covered? It is residential, it is SFR, it is multifamily, it is duplex. You know, if it is a residential property at all, that is covered here, which is somewhat unique as well, particularly if the challenge is investors swooping up and buying properties. You would presume that the legislature is primarily concerned about first-time home buyers, and presumably first-time home buyers are not buying apartment complexes. So let's talk about some of those exceptions. So the first one here is multifamily property, so property that consists of at least 2 units, and a deed restriction is recorded. So as many of you who follow California know, California is very active in trying to create incentives to record these affordable housing restriction deeds, which is that you will have a certain amount of the property allocated for affordable housing purposes. It will get recorded on title, and it will run with the land, meaning future owners of the property are bound by these same deed restrictions. So it needs to have a deed restriction in place in which at least 15% of the units will be allocated for affordable housing. These restrictions must be recorded within 3 years of the sale or exchange. And this is only applies to the first time that the property is sold or exchanged. Future exchanges it would not apply to. Exception 2 for subdivided properties. So here, where the taxpayer is the owner of the subdivided property, as long as the remaining property has not been sold yet. So, which makes sense. They're trying to, effectively they're saying is if you're adding additional units into the marketplace, we're trying to exempt you as well. So create housing stock, a wise exception. The third one here is interesting, but pretty flawed. So they have a qualified taxpayer's first primary residence exception, which is the first residential property that the taxpayer purchases and owns, and that they remain as an owner-occupant throughout the life of the property. They can sell in that first 7 years without paying this tax, which is very odd, because if you think about this, that means any homeowner who purchases their next home or trades up or trades down or does any of that sort of activity, they would still pay this tax. So even though this is described as a speculation tax, that means all of us who have bought our own homes already and just want to change our homes can't leave those homes for 7 years without paying a hefty penalty on doing so. Other exceptions. So obviously we talked about this as residential collateral, which means that your offices, true commercial assets. However, a mixed use asset is still lumped right in here as well. So even if it's a mix of residential and commercial, that tax would still apply. Residential housing that already has a deed restriction in place. Open spaces. So for example, if you deed the city a portion of the land for open use, and then properties that were otherwise already exempt from transfer taxes. So a few limited exceptions outside of this. So who does this tax hit? It's any individual or entity of a person who has purchased residential real property and sold or exchanged in less than 7 years. There's just two exceptions on the who. It is active military personnel, or they describe it as a decedent or a deceased person. So if a person passes away, their estate, this will not affect their estate effectively. It's the best way to think about this party here. Notably, if you go back into kind of the definitions of all this, if this is a speculation tax, and this is a tax that is designed to dissuade investors, this is a pretty broad and wide net that they're casting here, right? There's not outside of your first-time home buyer, this is a tax on you if you are a homeowner in California, right? That's just the nature of how this tax plays itself out. So we talked earlier about where are the funds going to be placed. They create a speculation recapture community reinvestment fund. So let's talk about this for a second. In the statute, at least 30% of the funds that are collected will be used for affordable housing. There is no definition of how they will be used for affordable housing, how a county can create affordable housing, how they will create any housing stock or incentives or otherwise. We don't know. But they will use at least 30% for that. 20% will be used for the school districts. 40% will be used for general transportation infrastructure or otherwise. And then 10% for the franchise tax board, or up to 10% to the franchise tax board, which is our taxing body out here in California, for administering this whole program. Which leads you to understand that, one, of all the money that they're raising, 30% of it will theoretically be used to create affordable housing. Two, this is all directed at the county in which the taxpayer actually resides. As many of you know, the activity in which most investors invest in, particularly for those that are primarily doing fix and flip or rehab type work, they are not doing these projects where they live. They are doing them in communities with older housing stock that would get the most value out of a renovation, which is, to put it this way, is the money's not going in the right place. It's not going to the counties with the actual need. It's likely going to already affluent counties in the first place. If this law passes, it would go into effect on January 1 of next year. So where are we? The bill was modified and proposed last week, a little over a week ago now. It is currently sitting in the Revenue and Tax Committee. It is not scheduled to be brought up for discussion when you look at any of the upcoming calendars. So at this point, it is still sitting inside of a committee without a next step per se. It is a tax measure, and in California, tax measures require a 2/3 vote in the Assembly and Senate. However, in California, we have 40 senators, of which 31 are Democrats. So we already have more than 2/3 in the Senate. And in the Assembly, we have 80 Assembly members, and 60 of them are Democrats. So you already have more than 2/3 in both, meaning that you would need defections from the Democrats to move this over. California has historically had what we call business Democrats. They often vote fiscally conservative. So even though we have this supermajority in place on these sorts of issues, that's definitely not a slam dunk to push this sort of legislation through. So what is what's the net of all this, right? And why is this flawed legislation? Because, as American Association of Private Lenders and Think Realty, and really any rational, citizen, I think we want affordable housing. It is a problem. We want to find a way to bring down housing prices. And California has done actually a few really smart ideas lately to do that. Aaron Norris is on this call. He'll talk about it in a second here, but we've got alternatives to this. And we've done some alternatives. And in fact, there's a lot of ways you could do this. This bill, if you just kind of play itself out for a little bit, what it does is it has the opposite effect in many ways. So the first is there's no actual mechanism to create affordable housing, right? You're going to create a fund, but what does that do? We don't know. The second one is probably the most important one, which is your average homeowner who already owns a home and moves to the next home. They're stuck in their home for 7 years. They can't sell it, right? Because they're going to get hit with a giant tax that will eat up their equity in the property. And so they're basically stuck in their property. So what are they going to do? They're probably going to move and rent out their property is what they're going to do if they can afford to do that, right? So these are properties that would have otherwise gone to the market and created some inventory, but now can't create inventory, right? And then separately, investors who would have potentially done a short-term fix and flip type project and place that property right back on the market, they're not going to be able to do it, and they're going to purchase this property, renovate it, and then rent it out, right? So what you're going to do is shrink inventory even worse. And if you were to talk to any realtor in California, they will tell you that our problem is an inventory problem, and that's the crux of where we are at right now. We already talked about the fact that even in the best case scenario, the money being raised here, 30% of it is allocated to affordable housing, however that will be used. And the rest of it is to be, to modify and make, presumably what is probably already a wealthy investor's neighborhood that much nicer. So hopefully they'll get some nice electric buses. And lastly, again, this applies to homeowners directly, even though it's designed to target investors. So these are our positions in opposition to, and we'll talk in a second here about how we're going to translate this into meaningful action. But before we do, I want to get Darren here as well, who's been kind enough to join us. And Darren's been able to get some real data behind this as well, because when you read through the legislation, there's not a lot of data in that legislation other than the fact of the 51% investor rate. And so I wanted to get a little bit of this, as well as get Aaron's kind of feedback as well, because Aaron really understands the California data side of this. And the data we were presenting here is the national data, and Darren is also familiar with the California data as well. So Darren, why don't I let you lead here for a second?
Sure, thank you, Nima. And yeah, I was actually just looking up, this has not been fact checked, but I was looking up that 51% in the data, public record data I have access to, and I'm not seeing that number anywhere. I'm seeing more like in the third quarter of 2021, more like 21%. So that, which is lower than the national, that's of cash buyers. So as a proxy for investors, it is possible the investor number is higher. But anyway, that's one piece of data there. So this is just, I mean, we at auction.com, are very concerned with this legislation as well. And we get this kind of pushback. So we've, on the buyers who are buying off of our platform. So I did have some kind of ready-made data points to hopefully combat some of the assumptions that are made out there. But basically, this is nationwide. We're showing this is property sold on our platform. So it is not the entire marketplace, but it's a good proxy for what investors are buying. And certainly the whole issue of this applying to homeowners is a much bigger conversation, but assuming that they're trying to go and get the investors and target the speculation by investors out there, this is really what this is speaking to. And properties sold on our platform at foreclosure sale to third-party buyers, which are usually investors. And then we track those in public record data and see what happens to those. And what we find is that of the ones that are resold, which about half nationwide are resold and half are held as rentals. But about of those resales, 71% go to owner occupants, are owner occupied after they resell. And then we broke that down into low income tracts and minority tracts where you'd be concerned about potential affordable housing issues even more so. And the numbers were very similar in those areas, and where 68% in low income tracts and 70% in minority tracts. I did really quickly pull the California data, and it's even, as you might suspect, California is a better market, a less appealing market to hold as rentals in for the most part, and a more appealing market for a lot of investors to resell, to flip. And so I'm showing in California, instead of the 50%, at least on our platform, of the properties that are sold, that are resold, if that makes sense, or flipped, in California, it's 75%. So investors are much more heavily reselling the properties they buy off of our platform. And the numbers are also higher in California when it comes to owner occupancy. It's 80%. So that 71% there in California is 80% that go to owner occupants. In low income census tracts, it's 79%. In minority census tracts, it's actually higher, 81% go to owner occupancy according to that data. So that's that piece of it. And then you can move on to the next slide. And just looking, this is a nationwide look, and we're extrapolating off of our platform and then using public record data. We estimate over the last 2 years, in 2020 and 2021 combined, when supply has been a big issue, people buying and then flippers basically who are buying and reselling, specifically at foreclosure sale, we're estimating have supplied about 141,000 properties nationwide to specifically to owner occupants. The average price to owner occupants is $261,000, and this is nationwide compared to the overall market at an average sales price of $381,000. So you're seeing lower priced housing going to owner occupants. Certainly 140,000 is not going to solve the affordable housing crisis, or whatever you want to call it, but it is certainly making a dent there, we believe, and it's not necessarily taking away from housing. The next slide just shows that it's not just the average price, but when we compare this to the incomes at the census tract level, the median family incomes, we're showing price to income ratios between 3.4 and 4.4%, depending on the slice of the data we looked at. And nationwide, it's 3.4 to 4.1%. Nationwide, it's 4.4%. So these are more affordable, not just on a kind of average sales price basis, but on a price to income basis, and looking at the incomes in the actual neighborhoods where these properties are reselling. And then the last piece I just wanted to show is, and let me check here if I have any California specific data, but yeah, this last piece is just showing that specifically honing in on the left-hand side there, which is looking at the buyers at our foreclosure sales, who are the investors. They are buying at about 63% of after repair value on average. And then they're reselling, and this is the after repair value is based on a 2022 AVM. So it's very recent, just to create a benchmark there. But they're reselling at 99% or 97%, sorry, of after repair value. So they're selling it close to full market value. And our takeaway from that, we don't know how much they're spending on renovations, but our takeaway is that they're adding value to these properties through renovations, and that's why they're able to sell them close to the full after repair market value. So yeah, that's and we do see a similar trend in California. One thing I don't think I have on here is the average days between the purchase and when it's resold. And these are not just quick flips. On average, these are taking 262 days between the sale on our platform and the resale in public records. So I think that's around 9 months that we're seeing these properties being rehabbed before they're resold. That's what I got.
Thank you, Darren. And Aaron, why don't you provide some color as well, because I know you're heavily plugged in here.
Yeah, the media is covering the Wall Street conversation pretty interestingly. So if you listen to the media, they're going to report that iBuyers right now make up about 2% of the market. And this drives me nuts. This is not an appropriate way to cover the iBuyers. I think Open Doors in 41 markets, they're not everywhere. So they're buying also in a very specific buy box. So in some markets, they make up 10% of the inventory. And they're also showing up as flippers. And all the data that's covered in the media, including Atom data, I don't know anybody that's separating iBuyers. And unfortunately, they show up as flippers. It compresses the data as far as what they're buying for, because they don't buy at a discount. It appears because of the way they structure their transactions that they're buying at full market value. They also put very little in repairs. I was just looking today at Zillow's fourth quarter letter to their investors showing that on average, they spent $5,555 renovating a property before they cycled it back to to sell it again. Um, I can tell you, just because I've been building homes and renovating since I was 5, I don't ever think I've spent $5,000 renovating a house, even in the 80s. So they're in the market of adding liquidity to the market. It's an error that they're showing up as flippers, in my opinion. And 90% of the time, the homes that the iBuyers are dealing with go back to owner occupants. So I wish there was an easy way to do it. Unfortunately, these iBuyers open entities all the time. It's not easy, but this is what your leaders are reading. They believe that what investors are doing are outbidding. Actually, what they're doing is they're buying maybe more than market value because they have money burning in their pocket, as we've learned from Zillow as they fold up their iBuying shop. But OfferPad, Open Door, everyone's buying, but for the most part, they're selling to owner occupants. The biggest concern is institutional, and this is a concern. So when Zillow decided to shutter their doors, 2,000 of the transactions that they were holding, they pushed to Pretium, which is terrible because they're operating in a buy box in the first-time buyer category. Builders are not building in this category as often as they used to because it's just not as profitable. So when you look at the National Association of Home Builders just released data showing that on average, it's about $100,000 in costs, impact fees, government fees to build a home. In California, even in the areas that maybe aren't as popular like Indio, Blythe, some of these third tier markets, lots go for 200 grand. So you're talking without sticks and bricks, you're looking at $300,000 out the door minimum to get the party started. So it's just not possible for them to build at the first time level. I wish these legislators would understand the data, the nuance in the data, and start focusing on the real issue. And they should be working with the private sector. They should be allowing SB9 to investors should be part. The private sector needs to be part of SB9, being able to do lot splits and build duplexes. We've got the talent, the experience. We're landlords. We've got access to private capital. They don't have to do anything but let us loose. This is a perfect example of when you're not at the table, you're on the table. And I hope everybody here starts getting involved in Apple, CMA, your local Realtors Association, and start fighting against some of the disinformation going on because it's going to hurt everybody. Imagine every flip that we do and how many lives we touch and how many contractors we use, closing agents. This is a terrible decision. Send pictures of before and after and start collecting your before and after pictures of your iBuyers. It's hilarious. I mean, all they have to show is the lines in the carpet where they vacuumed. Please start showing your local legislators this information and show them the difference of what we do compared to what Wall Street is doing, and that will help a great deal.
Thank you, and I really appreciate that.
One more thing.
Please.
RENA numbers. RENA numbers, the city should be playing with us because by law, they just got released 2021, all the RENA numbers, which is regional housing numbers. In the next 8 years, cities are being asked to create housing at rates they haven't done in a long time. The best numbers in housing ever. They're expected to replicate 8 years in a row. They cannot do this without the private sector. So I think there's an opportunity if we play this right and we show them real data to where they'll let SB9 and SB10 and all the accessory dwelling unit take off the brakes and allow us to build more inventory. They should, because if the cities don't meet their targets, the state will take over their planning departments. There's going to be fines and fees, including transportation and access to community block grants that they won't get. So they need to play ball and they need us.
Thank you, Aaron. And so, at this juncture, hopefully we've laid out the case for this legislation and really alternatives too. And so now let's talk about what we can do, right? The purpose of all this is well, in our experience, nothing moves like mobilization. And we'll talk about it in a second. We've got great partners and associations that we're working with, and they've got lobbyists and those sorts of things, and they'll have their impact too. But ultimately, people on the ground connecting with their local legislators is how action moves every time. We've been wildly successful with this approach, and we want to continue to be so here. So what do you do? One is we have lots of private lenders on this call, and that's great, and we love you. We're obviously an association for you, but you're not the one that's going to move the needle. For your purposes, we've got collateral you can send over to your local legislator. We've got a pre-printed form that you can just drop in some information in there, and you can connect, and we've got ways to do that on the website, and we'll talk about that in a second. And you do have a role, and it's important. And particularly if you've got a connection to any of these local legislators where we can get a meeting or otherwise, and we can have a conversation about the real data that's sitting behind this, that would be great. However, what's most important here is the party who is affected, right? There are people who are out, it's the real estate investor that are flipping these properties. They're the sympathetic voice because we know what they're actually doing here, right? They're the ones on the ground taking, substandard housing, getting it into a livable position, increasing the equity of all of the local neighborhood, really advancing these communities. And so they're doing the work that the legislators want them to do, right? If anything, they're the ones that are creating housing stock. They're doing ADU work. They're doing all the things that this legislation would effectively stop in its tracks. And so we also have created collateral for their purposes. So all we ask of you is if you can direct the real estate investors that borrow from you, if you can get them to the website, there's a form for them to download, pop in a little bit of their own information in there as well, kind of the projects they work on, the cities that they live in, that sort of stuff. And then we can get this all submitted, because then you can get the hands and feet of this will actually be understood. And so that's really where we could use some help here. And that's where the most of the mobilization effort will be directed at. And then let's also talk about kind of what we've done to date and the partnerships that are created. So a big special thank you to California Mortgage Association. I know their general counsel, Rob Finley, is on this call as well. They are very quick to act, very quick to join forces with us here. California Mortgage Association has dedicated lobbyists. They've got a opposition already in place to this bill, already communicating as such, and we appreciate them. They're similarly going to be working with us in terms of getting the word out campaign, right? So we're both going to be reaching out to the membership bases of our respective associations and getting them activated and involved. California Mortgage Bankers Association has their own lobbyists. They've also have an opposed position in place. They're all also working in the background, because remember, this affects all residential properties. So even large apartment buildings are coming under this purview as well. So they're engaged. And what I would say is probably the lead organization that is leading the charge here, and one we're very happy and thankful to be working with, is California Association of Realtors. They have already submitted a pure opposed position, which basically means that we want this legislation to not pass in any form. We're not looking to modify. We're not looking to correct this legislation. We're looking for this legislation to not continue whatsoever. So that's their official position. And we are working hand in hand with them as well. So thank you to all of our partners that are out there and for this extremely quick mobilization effort that is in here. So thank you for all the members of all these various associations that are coming in as well. Obviously, Think Realty is the sister company to American Association of Private Lenders, and that's really the real estate investor side of this. So thank you. You're the actors in this that will actually make action happen. So so thank you for that as well. So what should you do with all this information? First is we'll be sending out another email shortly hereafter, but it's already been in the emails you have already received for those of you that receive these emails. So there's a website dedicated for this. It's a landing page where we will keep it current about what's happening, changes in the legislation. We'll have video content. We'll have our official position on there as well. Any sort of letters with our partners will be posted on there as well. And that's where you can download the forms, and also it'll have links to contact the legislators that are relevant. So for example, right now, the bill is sitting in the Revenue and Tax Committee. So all of those committee members are all important people to be speaking with right now, beyond maybe even your local legislator if you live in that person's district. Call them if you can. This is ultimately the more, Eddie and I had this talked about this so often, is we had this happen in Florida, and we heard, the one feedback we got was we knew something was going on when our phones wouldn't stop ringing, right? That's really how you make change. You can spend as much money as you want out there, but nothing works like phones that don't stop ringing. So please make sure that you don't just sit as a passive standby as a person here that's not engaged in this. Because crazier things have passed, and I wouldn't take it for granted that this thing is necessarily dead in its tracks currently. Lastly, if you are in San Diego and you are listening to us right now, and particularly if you're in the Assembly Member Ward's district, love to speak with you and love to try to get a little bit of a coalition going there as well. We think this is good intentions without really an understanding of how it will play out, and we're hoping to just be able to participate in that dialogue directly. And at this time, we'll go to a little bit of Q&A. Eddie, I'll let you close up here as well.
Tag on to what you were just saying. Also, one really helpful thing is all of you are connected, right? And so not only do we want you to go to the website and download all that information and reach out to your senators, but also please forward this email with all these videos to every real estate investor friend you have. Many of you are connected into RIAs and other small groups, meetups across the state of California. We want to inundate California real estate investors with this content. And so please, when this email hits your inbox after this call with this video, make sure you share that as well.
Yeah. I'll go to a few of the questions that are sitting in here as well. The first question was, any guidance on single family built for rent? I mean, the application of this law is any residential property, right? So presumably if you build for rent, you're exempt as long as you're holding that property for 7 years, right? The key is the length of time in which the property is being held will dictate whether the tax is applicable. The next question here is if the bill were to pass, it will take effect on January 1st, 2023. Will this be applied retroactively, applying to single family dwellings that were purchased before this time period? It's actually unclear. I'm not sure whether if you already own your property and you're selling it, whether they consider, I doubt, I suspect it is property purchases that are purchased past January 1st, 2023, but to be determined. The next question is this tax in addition to income taxes? And yes, it is. This is in time, the design of this, if you just think about the legislator's intent, is to stop you from doing it, right? This is a please don't do this. And we're going to stop the activity in its tracks. So it's designed to be punitive, and more importantly, to make this that it doesn't make economic sense to come in and flip the property. That's the entire intent of this thing. They're looking to decimate the industry without realizing the result of that decimation. Next question on here is, would a property purchased, demolished, and developed as new construction be exempt? No, I mean, not for my reading of the statute as it is designed. I don't see any applicable exemption for that type of situation. The next question here is, what about an inherited property that will be transferred to children? The estate decedent may apply in this situation, but again, it's probably very nuanced based on the exact fact pattern presented in front of you, but it is not taxed at the decedent level. Right. Going into some of the chat box here as well. We've got, I don't believe this is a ballot initiative. This is if you can get 2/3 majority in our legislative bodies, which again, we have the votes. I think you are good there. Would a lender be excluded when selling an REO? It's a good question, right? Is they get acquisition at a point and then they're going to sell it shortly thereafter? Based on the statute as written today, I don't know. I think that they probably would. You gain ownership on this date at the REO, right? You sold it on this date. So that's an interesting question. So the next one is, am I understanding this correctly, that anyone buying a home for owner occupied and selling within 7 years will be responsible for this new tax? And if there was ever the crazy provision, that's the one. Unless this is the first home you have ever purchased, then the answer is yes. You, me, and everyone else who buy our next home, and we purchase it after January 1, 2023, hope you don't mind staying in the place for a few years, because you'll pay the piper a little bit more. And the last one is just some commentary. So I think that's all I've got here. Other than that, again, I appreciate everyone's time. The presentation will be delivered shortly hereafter, as well as updating links on the website related to these pre-printed forms. Greatly appreciate your time here today. And I'll let Eddie, if you have any closing remarks, feel free here as well.
I just want to say thank you so much for your team, Nima, for all the time you guys have put in. I know you guys have put a ton of time into this. And obviously, I want you to also, all the constituents are out there, no matter what, arena you have come from, to really consider that. I know sometimes when you think, well, I'm a flipper in Texas or Florida or some other state other than California, We had the same tendency when it came to the flipping tax that was proposed in New York. We kind of washed our hands from it, but we forget that as these state issues pop up and show other states what's possible, it really creates a waterfall effect. And so if something like this were to pass in the state of California, certainly a New York or an Illinois might follow. And so we have to be really careful to fight these on the terms that we've been given. And so while some of you might wash your hands and go, well, I'm in, a different state, it doesn't necessarily pertain to me. It will. And so we have to stop this at the very beginning. We have to fight it right now. And if you are, a casual flipper in the state of California, maybe you do only 3 or 4 houses a year, you still need to be just as active as everyone else. And what really helped us in the state of New York was at the governor's office was showing credible resources that were going to be missing from the economy of that state when flippers decided to go across the border into New Jersey or somewhere else. If you are a flipper and you have some credible testimony and you say, look, if this happens, I'm just going to move my cash elsewhere, that also needs to be told to your legislator. So please get active. Please share this out with others. And then lenders, I implore you to send this out to your base of people that are borrowing from you. This is an all hands on deck approach to this because we have to stop it now so that it doesn't waterfall and affect us in so many other areas later. I don't know if you want to answer these last 2 questions, Nima. I can, I think we've got another minute or so, but if not, I'll close it down.
Yeah, happy to do it as well. Is who initiated the bill? It's Assemblymember Ward. The comment was follow the money. Again, I assume good intentions. I really do. I don't think the legislators here are trying to cause harm. I just think that, remember that this same person is going to make legislation about your car insurance just as much as they're going to do about your health insurance, just as much as they're going to do about your schools. So they're not working, they can't be experts in everything, right? They've got good intentions, I presume, and they're trying to make good happen. I think they're really trying to address an affordable housing problem. I think that when you get to the technical, tactical level like we do, and you start reading through the bills and saying, well, let's just play this out, knowing how the industry works and how the client base works and all that stuff, then you kind of go, well, this produces a bad result, right? And I can tell you why it produces a bad result. You may not know this. And so ultimately it's education more than anything is the best tool we can offer here in these situations to really say is you're trying to accomplish this goal, this legislation doesn't, and here's why. And also, we're writing an official policy position paper as well. We're doing that jointly with CMA. It's also not only do we think this is a bad idea, but also here's some other ideas that are probably good ideas, right? We agree with you. We want affordable housing. We all do, right? So here's some alternative solutions that could actually get us there. And then the next question here was, what if a new entity is the buyer? Does that count as a first-time purchaser? Remember, it has to be an owner-occupant, right? So you've got to purchase this as your primary residence, live in the residence for 7 years. And so that's also a requirement as well. So it would not work if you just set up an entity to try to deal with the occupancy issue as well. All right, appreciate that, everyone. Appreciate your time. Looking forward to this, and I'm sure we'll be providing updates in the near-term future. Hope all of you have a wonderful rest of the day.
Thanks, guys. Take care.